Welcome back to Rocky Mountain Residential, a podcast from MCM Collective. I'm Kelly McBartlett, and today we have one of our experts, a lender in Northern Colorado, and an excellent lender at that, Justin Crowley. So Justin, tell us a little bit about yourself.
I work for First Western Trust. I've been doing this 23 and a half years, more than half my life. Been in Fort Collins area the whole time, but I do loans all over. Most of it's here.
That's great.
Yeah.
That's awesome. Well, so when people think about lending, especially when it comes to home lending, they're usually thinking about a couple of things, a 30-year fixed mortgage or an FHA loan. That's what most people think of, but the world of mortgages is so much bigger than that.
Sure.
Tell us a little bit about that.
Yeah, I mean, primarily most people just stick with your traditional 30-year fix, whether it's a conventional loan or FHA. A lot of people will end up in the jumbo loan territory, which currently that's anything around here, at least borrowing more than $806,000. Those loan products are a little bit more diverse. You have fixed rate adjustable loans where maybe the rate's only fixed for a certain period of time. More exotic products like reverse mortgages and construction loans for specialty programs and scenarios. But primarily 30-year fixed tends to be the most popular just because, at least for now, it's the safest program you can get. It's also the lowest payment. In a lot of cases, it happens to be the lowest rate as well.
Got it. So you mentioned in that conforming loan, or sometimes I think about that as like an FHA loan limit. That dictates a lot of the market, but a lot of people are borrowing far over those limits.
Sure.
So do you need to be concerned about those limits if you're borrowing more than an FHA or conforming loan limit? Or
I mean, definitely it pays to be aware of them because sometimes, and this is where, our world has become extremely unpredictable and sort of dynamic lately, is that as rates fluctuate up and down, so do the differences between programs. So sometimes jumbo rates are more expensive than conforming or non-jumbo rates, and sometimes it's the opposite. And so if you're buying in a price range where you might be above or below that limit, it's just good to know where that range is, so that if you have to allocate additional cash or look at like secondary financing to bridge that gap, if it saves you some money to get under that limit, it's helpful. There are also some technical restrictions of going into jumbo loan territory where the debt to income ratio limitations might be a little bit lower. There might be more stringent requirements in terms of how long your business has to be established if you're self-employed, or how much cash you have to have left over, what your minimum credit score needs to be. So again, just knowing where that line is, and if you're gonna fall above it, making sure that you know all the ins and outs of those programs, versus if you need to be below it or you're likely to be below it, kind of what those differences are, and if there's a financial benefit of staying under it.
And that loan limit varies across the nation based on county and different areas. What is that loan limit right now for Larimer County and Weld County?
So the conforming loan limit, if you're not dealing with government loans, is $806,500 on the nose, and that's the limit everywhere except for what they call high cost areas.
Got it.
So if you're in, let's say, Eagle County up by Vail, that limit is over $1 million. And it also varies by unit number. So if you're buying a duplex, that limit is higher than if you're buying a single unit.
Okay.
And then the government loan programs, so USDA and FHA, those are set by county.
Okay.
So every county has a different limit, and it's usually less than the conforming limit as well.
Got it.
And those are the ones that wildly vary county to county, because there's not one number that all of them are set at, just with high cost areas above it. They're all different. So Weld is different from Larimer, is different from Jackson, is different from Adams, and so on.
Right. Got it. Okay. And those change on like an annual basis.
They all get reviewed on an annual basis. Recently, they've been changing every year just because values have been going up. There's obviously a period of time there between, the housing crisis and sort of the recovery, where those amounts stayed consistent for a couple of years at a time. But yeah, every year they review them, and every year they release those new limits towards the end of the year.
Got it. So you kind of delved into this a little bit, but there are so many other loan programs out there besides FHA and conventional 30-year fixed 20% down loan.
Yeah.
But a lot of times that's what people have stuck in their mind as that's what they're going to have to do, one of those choices.
Sure.
when you're evaluating somebody's situation, how do you kind of introduce other things that they might consider without,
Yeah,
some people get a little turned off, or like they might feel like you're trying to be predatory by introducing other
sure.
things. Like how do you do that?
So, naturally these days, a lot of people start gathering their information online. And the tough thing about online, for anything, the internet is, when you go online, the internet's trying to get you excited about one thing. They're trying to get you to be interested in one thing. And so with mortgage programs, it's tricky because if you go into it not really knowing enough about the context behind those programs, you will tend to look at, 15 different arguments for 15 different loan programs and then try to sort out, kind of pick between them and figure out which one you want. Whereas really the approach that we take is when we talk to somebody, we have a conversation about, okay, what are you looking for? How much you want to spend? How much you have for down payment? And then we look at the mechanics of what they make and what their credit scores are. And we try to figure out the best way to put those pieces together. And that tells us what program we need to look at. So we're not looking at it from a, hey, is this program right for you? Okay, is this program right for you? Okay, and down the line for the 100 programs that exist,
Right.
it's more of a convergent process of, what's really in their best interest, not only in, complexity and time and logistics of, can they qualify for all these loans now, but what's going to save them the most money? It's going to give them the lowest payment, lowest down payment, et cetera.
And so some people might come to you and say, I really want a Chaffa loan, for instance.
Yeah.
And they might have that set in their mind, that's what they want.
Yeah.
You might evaluate it, and that might not be the best loan program for them.
Sure.
What's that conversation look like to get them over the,
Yeah, it's kind of like somebody going into the ER and saying, my arm hurts, give me a cast. They go, well, let's slow down. Let's see, if that really works. So sometimes people will come to us with a specific program in mind, and maybe that is the best fit for them. But oftentimes when they'll say, hey, I heard about this program, this is the one I want, we'll look at it and we'll say, okay, well, this does fit, and here's what these numbers look like, and here's sort of the benefits and drawbacks. Here's another way to do it, and we'd recommend going this way because of X, Y, and Z. And so if we can show them side by side the program that they wanted versus an alternative program that might be a better fit, and let them see the differences, they'll often, understand why that difference is. And they won't really see it as us trying to steer them into something that might not be what they want or what they think they want, but really just an alternative of, hey, you qualify for a bunch of stuff.
right.
This is just a less expensive way of getting to the same endpoint. Let's talk about that. And
Sure.
and most people are very open to that if they know that it's saving them money.
It's in their interest. You're
sure.
talking about their cost, their expense.
Yeah, because in a lot of these programs, like CHAFA, for example, which is a down payment assistance program for first-time homebuyers, where it's a state-sponsored program, so it uses government funding. It's a great way to get into a house if you have challenged credit and very limited funds for down payment. But what we found is in most cases, is that it's not the most ideal scenario. It's either more expensive, more restrictive, or both. And so if you can tell someone like, hey, I know you want this program because of all these things that are put on the marketing materials, but these exist elsewhere too.
Mm-hmm. Yeah, that's great. You also mentioned this in one of your responses here, but sometimes, or a lot of times, it seems like a lot of lenders will look at somebody's qualification as like a spreadsheet almost, of like, this is the exact amount of down payment these people are willing to put into their purchase or available funds. This is their debt as it is right now, and it can't change. And they kind of qualify them based on that.
Sure.
I've seen several times where you've kind of looked at somebody's situation and moved numbers around to make either their qualification better, meaning maybe they could purchase more than they thought, or maybe by restructuring some things, they might save some money every month. So could you tell me just a little bit about that and how you approach it?
Yeah, so sort of the traditional way of going about lending is you have somebody go online by themselves, they fill out some form, some application, somebody reads it and then tells them, hey, based on the stuff you gave me, this is what you can get today for financing, take it or leave it. And just like everybody's situation is different, sometimes there are nuances to their situation or their financial profile or what they're aiming for that can be easily tweaked to get a better result. So for example, we have a lot of people that will call or come in and they'll say, well, this is how much I have for down payment. This is the monthly payment I'm comfortable with. And we look at it and go, well, this is great. All this works. But the house that you told Kelly you want is priced a bit above that. We're not going to be able to get away with these. Let's look at some other things. And so we've looked at things like equity repositioning, which is basically just a fancy way of saying, hey, if you've got a car loan and a student loan and credit card debt that you're paying, what if we use some of the money that you have for down payment, paid those off, had a slightly higher mortgage payment, but a substantially lower payment on your other debts? Does that make a higher payment more comfortable to where you can actually get the house you want? Or, a big thing right now is temporary buy downs. These are temporary reductions in the interest rate monthly payment that last for the first couple of years of the loan, so that if somebody has sort of a house profile that they need to work for their family, but with current rates and current prices, maybe that produces a monthly payment that's too high for what they're comfortable with. A temporary buy down allows them to kind of ease into that higher payment. So if they have, let's say, debts that are going to be reduced over the next couple of years, or income that's likely to increase. For example, we have a lot of young families where maybe their youngest kid's 3, so in 2 years they're going to be out of daycare and they're going to save all that money. And maybe they're in a salary position where they get merit increases every year. So they look at it and go, well, the payment that's going to be produced by the house I want today is not comfortable now.
Right.
But in 2 years, between not having daycare expenses and having more income, it will be, comfortable. So rather than wait until then and risk paying even more for the same house,
Right.
a temporary buy down allows them to start with a payment that's comfortable today and ease into it as their sort of financial profile changes with it.
Sure.
But these kind of sort of, I don't want to say epiphanies, but kind of insights into different paths to get them to the spot that they want to be in, they're far easier found just with conversations.
Sure.
And so we're always looking for better ways to put the pieces together and find what kind of levers we can pull on if we need to get a square peg into a round hole.
Yeah. Well, and I mentioned it before, but I've seen you do that several times with buyers that I've been working with, and I mean, it's a great tool for people to take advantage of, to look at their entire financial picture and see exactly what the best way to approach what the goal is. So, there's a lot of variability in rates right now, up and down and all over the place. They were really high a year and a half ago. They've come down a little bit now, compared to what we were seeing even 6 months ago. How are you helping people that are calling you saying, should I refinance? And when should they be thinking about that question?
Yeah, good question. Well, lately with where rates have been, most of the time the rates aren't better than what they have. And in a lot of cases they're higher. And, eventually they'll come back down just like anything. But typically, when someone calls and asks if it's a good time to refinance, people usually refinance for one of 3 reasons. They're either going through a divorce or a life change where they have to redo a loan, regardless of whether or not there's a financial benefit. They have additional equity that they need to pull out, either by consolidating other debt that's more expensive. Maybe they got college to pay for. Maybe they need to do an addition or a renovation. But primarily people are wanting to refinance when they want to save money. And so we look at, what's your loan costing right now? What's your rate? Is there mortgage insurance? And if we redo that loan on today's rates with current value, is there going to be a tangible savings there? And more importantly, is there going to be a tangible savings that justifies any cost associated with the refinance? And in most cases, we don't have a rule of thumb where we say, oh, you have to save 0.5% on your rate or 1% on your rate. What we look at is there an option where we can lower your rate and your payment without it costing you anything? Because there are refinance scenarios where the lender can pay all those fees. And is that monthly savings enough to justify the time? So for example, if you've got a $500,000 loan and I can lower the rate by, let's say 0.25%, and it costs you nothing, it's only going to save you about $80 a month in interest. And some people might say, well, $80 a month in interest, it's actually a little bit more than that, but $80 a month on the payment, let's say, there are plenty of people that say, well, shoot, if it's only going to take a couple hours of my time and I'm saving $80 a month, and what do I care?
Right.
And some people, that's worth it.
Right.
Some people will say, I need to save more. So we find that threshold where if we can save the money with no cost, if it makes sense, then we have the secondary conversation of, okay, it makes sense to refinance right now. Now let's find which rate and cost combination actually makes the most sense. So maybe there's a rate that's lower, but it has some costs involved, and we can kind of do the cost benefit analysis to see which one's right. But generally speaking, yeah, the best time for somebody to refinance is whenever they can save enough relative to the cost to refi to make it worth their while.
Yeah, yeah. That's great to hear. And I mean, it's probably helpful for a lot of people that are thinking rates have not come down enough to make an impact, but maybe their situation, it would make an impact.
Yeah, and with as erratic as rates have been over the last couple of years, I mean, last Monday was a prime example in that, and that would have been Monday the 7th of April.
Yeah.
Rates hit the lowest point and the highest point that they had in several months, all in the same day. And of course, by the time they touched their low point, within 20 minutes, they were already shooting back up because of all kinds of stuff. And that's really what we've seen become the new normal in interest rates these days, is that these rates move pretty quickly. They tend to move higher and faster without any warning than they do when they move lower. So my advice to everybody is, if you're in a rate that's high and you want to be ready to refinance when the rates come down, get with your lender and have the discussion of what that looks like. You know, so I have a lot of people, a few dozen of them, in fact, that I've already had the conversation of, okay, if rates hit this point with this amount of closing costs or lower, you know, do you want me to just get everything ready, lock in the rate, and then call you? Or do you want me to chase you down and have the conversation and send you the numbers so you can take a day or two to decide first?
Right.
In which case we might miss that window.
Yeah.
And that, in my opinion, is the best way to approach it, because a lot of these windows where rates dip have only lasted for, you know, a couple of days, or in some cases even less than an hour.
Well, I imagine that's like, even on the purchase side, that's changing the way people approach locking rates and figuring out their budget. And
Sure.
Are you getting a lot more phone calls these days with people checking in on things before they write an offer? Or
Yes. Yeah. They do. And rightfully so. You know, and there's plenty of times where people get under contract, and by the time they get their offer accepted, the rate's different,
right?
For better, for worse. Obviously, when it's better, it's good.
Right.
When it's worse, it's stressful.
Sure.
So, to the same extent, you know, when people are buying, we tend to give them an idea of the range of rates, remind them that they can change. But similarly, when they get under contract, you know, we tell them, whatever the rate is at the time you get under contract, if you can live with it, just lock it. Because if you lock it and they go up, you're good. If you lock it and they go down, and most lenders have policies like this, but like our policy is, once we've locked, if the rates reduce during the contract, before you close, if it moves by at least 0.25%, we can float it down and it doesn't cost them anything. And so, you're kind of protected on both sides. But there are still a handful of people that, you know, will get under contract and they'll be convinced that rates are going to go down, and they'll wait. And more often than not, those rates go up.
Right.
Because usually if they go down a little bit, they're still convinced that they're going to keep going down.
Right.
And then that one day where they pop up, you know, at least most of the stories I hear of people playing that game, they end up with a higher rate than what they would have been at. So yeah, best and safest advice that I give people is lock when you have a rate that you're comfortable with once you're under contract, and then hope for a float down.
Yeah.
You know, worst case scenario, you're going to end up where you locked.
Yeah.
But best case scenario, you're going to end up somewhere better.
Yeah. Great. Yeah. That makes a lot of sense. So going back to refinance, you know, when people have a bevy of properties that they own all at different rates, are you approaching that conversation with them any differently for their investment properties or second homes that they own? Or
yeah, I mean, kind of going back to the whole mortgage planning concept that we talked about, just having a conversation, figuring out, are there different ways to get the same path? We always take that holistic approach when we know they have other real estate, because we don't want to be doing something in the now that might affect something in the future on some of their other properties. Or if we spot an opportunity where maybe, you know, like if somebody calls and says, hey, I need $100,000 for college tuition for my kids. I want to refinance this house. But then we see they've got these other homes over here. Maybe one of these has more equity. Maybe it already has a higher rate. If it's cheaper to leverage those other properties, we're going to look for those opportunities. You know, again, most people going online and filling out a form are probably not going to be able to identify those opportunities. So these mortgage planning conversations are hugely valuable. Even if we end up at the same spot, at least we kind of turn over those stones to see if there are any opportunities there. And maybe not for this opportunity, but maybe the next one. And so a lot of the clients that we've been working with for, years and years, and some of them even, decades, we've gotten to know their financial situation enough to where if they call and say, hey, I'm going to buy a ski condo here, or I'm selling this house and buying this place for my kid to go to college out there. We have that background to kind of pull in those details to see if it makes for a better plan.
Sure.
But yeah, and that's the long and the short of it, is that when you start borrowing hundreds of thousands of dollars, if you do it one time on one property, it's pretty easy to manage on your own. Most of them kind of figure that out.
Right.
But the minute you have 2, 3, 4 properties and other complex changes in your plans and financial profile, it helps to keep those in the conversation.
Sure.
Yeah.
Thinking about that, Justin, I when I've sent clients to you or I've called you to evaluate things, usually that conversation and what you've just described, evaluating this full financial picture, takes a lot less time than I thought that it would. So like in my mind, I'm envisioning, we're going to sit down for 3 hours and go over this entire portfolio of properties. That doesn't seem to be the case when I send people to you. Tell us about that a little bit.
So, and part of this just comes with time. Like I said, I've been doing this more than half my life. So I'd say the first, 10, 12 years I was doing this, it was not as efficient and quick. But most pre-approval conversations that we have are 8 to 10 minutes long. And we're getting just enough info to at least go back and then review, okay, here's, based on what you want, here are the numbers, rates, and products that would be available that would make the most sense to look at. And then we kind of bounce it back to the buyer or the client to see, how well that's resonating with what they were expecting to hear. Because again, if you got thousands of different loan programs out there and considerations, but if we can distill it down to like 1 or 2 that make perfect sense for that person, we can save all the time and dive into the weeds on the other stuff. But yeah, it's a pretty easy conversation for most people. Where those conversations can run longer is if somebody is self-employed, they have multiple businesses, they have a more complex financial profile. Let's say they're a commissioned employee, but they just changed jobs 6 months ago. These are types of things that will extend that conversation a little bit longer, but it's never something we can't figure out in the span of a casual conversation.
Yeah.
Sometimes there's some follow-up if we need to look at tax returns or talk about, maybe there's some funds that are available in a 401k account, but they're not quite sure how much they can tap into. So there's, oftentimes follow-up questions that help us kind of narrow down those options. But yeah, usually within 8 to 10 minutes, we can get enough information to start talking about the programs and the results and the payments.
Yep.
And then if we can find out that we're on the right track that quickly, it makes the rest of the process a lot less intimidating for people and a lot less cumbersome.
Yeah. It's it seems a lot simpler talking to you through these things over the years than what I've imagined. So it's great to hear how you approach that. So to leave a buyer in today's market with any words of advice, what would you say right now with navigating the economy, their job, buying a home, all of those things?
Yeah, I mean, the best and simplest advice is just start planning early. The earlier you start the conversations, the easier the process is. I tell a lot of people, especially first-time home buyers, that if you do the financing part correctly, it's by far the most boring and unsexy part of the home buying process. It's very easy, very boring.
Yeah.
It's all paint by numbers, but the goal is you want to get that plan together early, because then you're just walking the path. So the sooner they can start having the conversation of, what kind of financing is available, how much money do they need to do some work on their credit? Are there conversations that they need to have with family members to figure out, okay, I know at the wedding they said they'd give me some money for down payment. Well, was that $1,000 or $100,000?
Right.
The sooner they can put those pieces together and know what they have to work with, the easier it's going to be for them to come to somebody like me and within 8 to 10 minutes know exactly what they can afford, so they can go out and start shopping and really put all their energy into finding the right house.
Okay. That's great. To follow up on that, even calling you probably should be sooner than what people think that should be.
Yeah. I mean, I always tell people, once you're within about 3 or 4 months of planning on closing on something, there's no reason to wait any longer, because pre-approvals and credit reports are good for about that long.
Yeah.
But if there's something that needs attention or needs work, especially credit scores are a big one. You know, your FICO has a huge impact potentially on what your rate and your closing costs could be. Sometimes to the degree of thousands of dollars at closing or hundreds of dollars a month of the payment. So just maximizing that credit score can be hugely valuable. The sooner you know what you could be doing to get that higher FICO if you need it, the higher the chance that you're actually going to be able to do it. And that could be something as simple as, and some of the stuff is contradictory. Like we have people that come in and I'm like, well, you've got a 729 credit score or whatever. And if we get you to 760, it's going to save you this much a month. You still qualify.
Right.
But hey, you've got this credit card you've had for 5 years. You haven't used it for 2.
Right.
It's the only credit card you have. Go put dinner on it. Wait till you get the statement and pay it back to 0.
Right.
That'll recharge that history and bring your score up. And sometimes people don't think of that. So just having the conversation early so that you know if there are any steps you can take to put yourself in a better position.
Yeah.
You may not have to, but knowing ahead of time is valuable. It's good.
Well, thanks, Justin, for joining us. This has been great. We appreciate you being here.
You're welcome. Yeah, good to be here.
Yeah, thanks.
Thanks.
Thanks, everyone. We'll see you next time.